Welcome to Personal Wealth Strategies, our monthly webinar series here that we've been doing now for 3 plus almost 4 years. Only missing a couple months in there, so we appreciate you hopping on. If this is your first time, if this is your 10th time, or anywhere in between, thank you for joining us today. We've got a super insightful session with the passing of the One Big Beautiful Bill Act. That has opened up a lot of opportunities. It's definitely big, and we're going to go through some of that today. But before we get into that, I want to introduce some of our key speakers. And we have an additional guest as well that I want to make sure to introduce as well, bringing on an accountant to help us out. But first, before that, I want to introduce myself briefly. For those that you don't know, Justin Rice, a CFP, decade of experience serving physicians, serving retirees, helping them to optimally plan for their futures. I joined David Balin back in 2018. David Balin has a lot of experience in the industry.
More than
Definitely
a decade.
definitely more than a decade, more than 2 decades of experience.
Keep going.
Serving more than 3 decades of serving similar markets, and it gives us a wealth of knowledge into all the different types of tax bills, retirement planning, investment planning, long-term care planning. Adds a wealth of knowledge there. And then our special guest, Joe Romano, who is a CPA, and we wanted to get an actual tax professional in here to get into the weeds a little bit with us to help of what he's seeing on the ground. And now keep in mind that this bill just passed a month ago, and we don't know exactly how things are going to be implemented, but at the end of the day, it's going to be some type of tax preparer that's going to have to deal with all of these new regulations, all of these new lines on the forms. And so that's why we wanted to bring Joe in, very experienced accountant, controller, CFO, has done a lot of different roles. He's personally worked with a handful of our clients as well on their own tax returns. So very thankful to have Joe with us here today. Joe, thanks for joining us.
Thank you, Justin. Thank you, David. I'm glad to be here and would like to help as much as
Awesome.
I can.
No, appreciate that. And I'm going to be running kind of the major overall slides of the presentation, and we're going to have comments from Joe, from David. But before we get into even that, I want to cover a couple of key things about decoding the One Big Beautiful Bill. First and foremost, the name. The name of the law is the One Big Beautiful Bill Act. And just because we call it that way, that's the name of the bill. So it doesn't mean we like the name, doesn't mean we don't like the name. It doesn't mean we have like a preference of the bill, whether we think it's good or bad. It is what it is. The law is the law. We're here to report on that law, and that just happens to be the name of the law. So by saying the name, we're not making a political statement. We are just saying the name of the law as it is written. And now people are trying to think of different ways to say it. I've heard of like OB cubed. I've heard of just the OBBBA. I've heard of O3B, OB3. So I don't think we've settled on a name, a shortening name yet, but I'm sure that will come as all of the experts look at the One Big Beautiful Bill Act. And no, we're not going to say that all out every single time when we're talking and referencing the act. Number two, this is not going to be a comprehensive presentations of all the different things within the bill. We've distilled it down to get a shorter presentation of what we think will most impact you, the end client. We were talking in preparation for this to Joe, who attended literally a 4-hour class on the act, and they didn't even go through everything. So to think this is going to be comprehensive would be utterly ridiculous. So we're just going to get to the key statements of things that will actually impact you and that we think is pertinent for you. Now, something else to keep in mind is that your personal circumstances may vary. So you may hear things on the news or like little pieces about the bill or single provisions and say, oh my God, this is going to be great for me. Oh my gosh, this is going to be chaotic for me, and anywhere in between. But you can't judge the impact of this bill by just a single provision. There's a lot in here. And so there may be something that's not so good for you, but other things that would be good for you. And you don't know how that's going to, offset each other until you look at it from a comprehensive perspective. And what we also want to do is double check everything. double check, meaning that this bill is still only a month old. It's a tiny little baby. And so we're still all digesting the roughly 900 pages therein. So before you go and say, oh my gosh, that's a great idea, let me go act on it, definitely double check references, double check with your experts before going in on acting anything you see online, or we even say here today, just because it's so early. And then the final piece that I want to make sure to ground in is that, like I said before, we don't know, we know the law is there, but we don't necessarily know the implementation of the law or the ins and outs of how they're going to bring the rules into reality. And so there's still some haziness there that we will get clarity over time. And so if we're vague, that's probably why we're being vague, because we don't know exactly how things are going to be implemented. David or Joe, anything add there of the general overall disclosures before we get into the key topic?
Justin,
No,
I
the only
just,
thing.
go
Okay,
ahead,
go ahead, Joe.
I just want to add that, yeah, like Justin said, the bill's a month old. Um, we're still trying to decipher and interpret the law as it is right now. Um, some of these things are going to apply in 25, and some are going to apply in 26, and later on, some are going to sunset, which means that they're going to go away, and some are going to be permanent. Then these things are, even though it's a law right now, the interpretations and the gray area, which is something that happens in a tax law every day, is still going to be open to interpretation. So I just wanted to just agree with you there, Justin.
Thank you, David.
Nope, that's it. Typically, when a big tax bill like this comes out, there's going to be a technical corrections that's passed afterwards that says, here's all the things that we missed. And then the IRS gets their hands on it. Then the tax courts get their hands on it. So we're not above all those. They're going to change our answers. Doesn't mean we weren't right today. It just means we may not be the same answer tomorrow.
Yes, absolutely. All right, so let's get into some of the meat and potatoes. And one of the things that I want to start with is what's staying the same or close to the same. So what is staying the same? The tax bracket. So back in 2017, starting in 2018, we had the Tax Cuts and Jobs Act, which reduced a lot of the tax brackets that we have today. That was set to sunset at the end of this year. And in 2026, we were going to go back to the ordinary income tax brackets prior to the Tax Cuts and Jobs Act. However, within this OBBBA, those tax brackets passed in the Tax Cuts and Jobs Act that was going to sunset were made permanent. Now, throughout this presentation, when we say permanent, we put it in quotation marks, and because the definition of permanent is not what we would normally think in English. Like permanent typically means like it's always going to be that way, never is going to change. So that is true within the tax code unless Congress comes in and changes it. So it's permanent until it's changed again. And so when another bill comes through, they will be able to change these tax brackets. But if they never come to an agreement again, never pass another bill, this will be the tax brackets in perpetuity. Also, just another fine note, the lower brackets, the 10 and 12% brackets, got a little boost of extra inflation adjustment for next year. So more income is going to be taxed at the lower brackets, and then you're going to get into the 22% bracket. The standard deduction remains higher, roughly doubled from what it was, and actually is effective for 2025. And so we're getting actually a little bit of an increase this year in the standard deduction for 2025. Married filing jointly is $31,500 that we wouldn't have received if that was not passed. Also, it's going to remain that way. So next year, we were going to have the standard deduction cut back in half. This year, by the passing of the bill, that's going to stay roughly doubled, and there's going to be inflation adjustments there going into the future. The final piece, itemized deductions, what remained close to the same. Miscellaneous itemized deductions still aren't there. You still have a cap on the mortgage interest payments of $750,000 of principal. So those remained the same. We're going to talk about some little things different in itemized deductions later. But Joe or David, any comments on, roughly what's staying the same or status quo, at least from the Tax Cuts and Jobs Act perspective?
Yeah, Justin, for the lower tax brackets, the extra inflation adjustment, that's a one-time only thing for 2026. So, just so that's clear on that. Doesn't mean the higher tax brackets get that. It's more the lower brackets, 10, 12, and I believe it's also 22 right now would get that extra adjustment. Um,
Yep.
cost of living adjustment, extra adjustment. That's what that is.
Yeah, perfect.
Hey, Justin, I'll throw in something too. We're used to thinking about tax brackets that it doesn't take much income to kind of work your way up these tax brackets. So it's not uncommon to think that you're going to end up somewhere in the middle. But if you think about this, in 2026, someone making $100,000 of adjusted gross income is still in the 12% bracket. There is a lot of room in those 10 and 12s to take advantage of that. Now, the flip side of it is when you look at the standard deduction with that increase, it now creates even a higher hurdle to get to the itemizations. So back to 2017, prior to the Tax Cuts and Jobs Act, a lot of people were itemizing. Today, far fewer itemize, and the number who will be itemizing is likely to be even smaller going forward. The final thing I'll mention here, because I know we spend a lot of time talking to clients about this, for those who are itemizing, is the idea of chunking. The idea of 1 year shooting to itemize and then next year not, and then the following year itemize and the next year not. With the hurdle rate being even higher, the concept of chunking, trying to get all your deductions in 1 year becomes even more critical.
Yeah, great idea. Great planning strategy takeaway of like, well, this is what it is. What can we do to help maximize our own personal situation, minimize our tax payments? That's one of those ideas, David. Perfect. All right.
Let me add something else to that, Justin.
Yeah.
What David said in terms of chunky. It's even going to be even more relevant now going forward with, and you'll get to it, but with the SALT deduction. You can. What's going to happen is you can chunk in terms of real estate taxes. So you're able to deduct $40,000 instead of the $10,000 in taxes. So you might be able to, prepay your taxes in December instead of paying them in January, February, 1 year, and then the next year you're not. So that could be the difference of you getting X amount or a bigger deduction in the 1 year versus the other year. So that's a good planning tool also.
Yep. Definitely, for sure. Thanks for that, Joe. Some more unchanged items that you may be familiar with. So the child tax credit, that is still sticking around. Effective 2026 for next year, it's actually going to be increased slightly to 2,200, and it's going to be indexed for inflation going forward. Also, they increased the refundable portion, meaning that you could actually get that even though you don't pay the tax. So that's a very powerful potential tax credit there for if you have children. For business owners with pass-through entities, the qualified business income QBI deduction has been extended. So that was one of the things that was introduced within the Tax Cuts and Jobs Act that was going to sunset out. But now going forward, it is going to stick around that QBI deduction. There are some phase-out ranges and limitations. They were increased, so you have a little bit more of room there. But you want to look at qualifying for that. And if you are in a phase out, that could be a potential tax planning opportunity of if you're able to reduce your income via 401ks, via itemized deduction chunking, as we were just talking about, you could qualify for potentially even more of a deduction if you're within that phase out range. So another planning opportunity that you want to take a look at. Student loans and education. So debt discharge via death, disability, still not taxable. Public service loan forgiveness, still not taxable. Employers, and a lot of people didn't even know this or take advantage of it, but they may actually, for employers can pay on employees' student loans up to $5,250 per year, get a deduction for the business and have it be non-taxable for the employee as an employee benefit. So that is something that's remaining in the law, remaining unchanged. And then finally, ABLE accounts. for those beneficiaries with disabilities, you can have contributions remaining eligible for the saver credits. You can do 529 to the 529A, those ABLE accounts, those continue. And then the contribution limits are still at the annual gift tax exclusion amount, which I believe now is $19,000 for the year. Anything additional to add to these unchanged items?
So for the child tax credit, just so we're clear, it's under 17 years old for the credit for the child. That hasn't changed. The other thing is it gets phased out for married filing joint at 400,000, and for everybody else, it's phased out at $200,000 of income. The other thing I wanted to add for the QBI for the phase out range. So that's a big jump. That's a big number for 150 for joint filers. It was 100,000. So that increased 50%, for that. So that's a big number for somebody who owns a business. It's very helpful for small businesses.
Awesome. Appreciate that that additional context there. And something else that I didn't say as well, if you have specific questions, I believe we've got the Q&A feature rolling. If not, let me know and try to put something in the chat. But ask the questions, we'll be able to answer those to the best of our ability as well, so that we can make sure that we touch on the topics that you most want to talk about. All right, so what's meaningfully different? So we've got like kind of the three phases: what's unchanged or close to the same, what's meaningfully different, and then completely new. That's kind of where we're going in this general overview. So now we're in the meaningfully different, meaning it's been around, but there's some significant changes there. So the first one, as Joe alluded to before, was the state and local taxes. Back in the Tax Cuts and Jobs Act, that was capped out at $10,000 for married filing jointly and single, where you couldn't take more than $10,000 towards an itemized deductions for those state and local taxes. That significantly impacted those in the higher income tax states like New Jersey, where we are, New York, California, et cetera. And so that pushed a lot of people over into the standard deduction. But now the max itemized deduction has increased to $40,000. Now, what's interesting here is it's $40,000 for every type of filer except married filing separately, where they cut it in half. But there was talk about eliminating the marriage penalty here, but there's still a pretty significant marriage penalty, because if you think about it, if you have two individuals, they each have their own 40,000, they get married, now they have the same $40,000 cap. So it actually made the marriage penalty even worse than the 10K cap. And so that's an interesting thing to potentially pay attention to. Another, when it comes to the SALT deduction, is this is phased out. So it's not 40,000 for everybody. As soon as you hit $500,000 of income, and by the way, that's also single or married filing jointly, you start to phase out from 500 to 600,000 to go from the $40,000 of the itemized deduction back down to the 10. So if you're, for the majority of people under 500,000, you're going to be able to itemize up to that $40,000 of state and local taxes, and that's effective this year. So even though the bill passed, halfway through 2025, it still this provision affected all of 2025, but that does phase out in 2029. The alternative minimum tax, just want to touch briefly on this, was basically eliminated with Tax Cuts and Jobs Act. Not actually, but very, very few people were actually subject to the alternative minimum tax. Now there are going to be slightly more people subject to the alternative minimum tax compared to the Tax Cuts and Jobs Act, but still greatly reduced from before. So this is something that a lot of people on this call will not have to worry about per se, but it is something, in 2026 and beyond that you need to have your eyes on just in case. And a lot of this, if you have incentive stock options or things like that, that's where the alternative minimum tax will come into play most often. And then finally, the business owner provisions that have changed is Bonus depreciation is back. Bonus depreciation was slowly phasing down from 100%. Now it's back up to 100% for anything that you're expensing after January 20th of 2025. And then if you have qualified small business stock, so you have a qualifying C Corp, that's a qualified small business, you have a tiered gain exclusion now based on your holding period. So before you had to hold it for the full term and it was all or nothing. Now, if you hold it for shorter periods, you do get a certain percentage of the gain excluded if you were to sell that company. Joe, any comments on what's meaningfully different here?
Yes, Justin. There's a couple things. The 179 deduction, so that increased from 1.25 million to 2.5. It doubled. So just to be clear what that means, again, a lot of these things are tied to small business. And it really is helpful to the small business for a 179 deduction, which means that you get an immediate deduction on your tax return for capitalized equipment. So anything that is that is significantly increases the business, so buying equipment, improving your building, anything that has a life of generally more than like 3 or 5 years, whatever it is, buying a car, buying equipment, buying a building, improving the building, whatever that is. There's that 179 deduction, you can get another $1.25 million for that, for starting this year, which is it's significant for a small business. And the other thing is the bonus depreciation on top of that. If you wanted to just not take the 179, because there's some things that 179 you have to qualify for. The bonus just gives you an added deduction. You buy a piece of equipment, for example, for 10,000, and say you get depreciation of 5 years, you get $2,000. The bonus gives you an additional 1,000. Instead of you taking the whole deduction, you might get just an additional deduction on that. So that's very helpful too. So between those two, it's very helpful for the business for additional deductions and expenses.
Very good.
And Justin, what I throw out to our listeners today is you don't have to memorize all these different rules because there are a lot of them. And we certainly know that taxes can get very complicated, but we want to give you an overview. But what you really should be listening for is how can I take advantage of these new tax laws? And one of the things I think is real important to pay attention to when we talk about the SALT deduction, state and local tax deduction. Yes, the cap has moved from 10,000 to 40,000. But that second line or third line under there, extra SALT deduction phased out by 30% for income over 500,000. That is a really steep phase out. So a lot of the talking points around the law where some people were saying this is going to provide tax breaks to the middle class, which I think it does in many ways. Some were saying it doesn't really affect the high income people the way we'd want it to. Well, here's an example where it really can affect someone in a high income bracket. Because if you think about this, the difference between earning $500,000 and $600,000, if you have $40,000, if you're going to take that $40,000 SALT deduction, means you have to give back 30 of that $40,000 deduction. And if you're giving back 30%, I'm sorry, if you're giving $30,000 and you're in, let's say, for the sake of easy math, you're going to make up a 25% tax bracket. If I have to give back $30,000 of a deduction in a 25% tax bracket, 25% of $30,000 is $7,500. That's $7,500 more in my tax bill because I made an extra $100,000. So as a strategy, if I'm in that phase, if I'm in that range of 500, 600, somewhere in that range, I got to pay attention to things like my capital gains. I got to pay attention to my contributions to retirement accounts. I got to pay attention to my charitable contribution. I got to pay attention to all this because there's going to be a pretty steep penalty in terms of additional taxes I have to pay above and beyond my stated marginal tax rate. We'll give an example of that later, but there's a lot of opportunity here for planning.
Yep. Absolutely. That is the bottom line. Opportunities for planning. All right, so now we're going to shift into what is completely new within the bill. And President Trump, as he was running for his second term, made three overall major promises: no tax on Social Security, no tax on tips, no tax on overtime. And this slide kind of addresses that. So the no tax on Social Security, that didn't happen. What did happen was this deduction for seniors, meaning there's an additional $6,000 deduction for each qualifying individual if you're over 65 years old. So it has nothing to do with if you're claiming Social Security, if you're not claiming Social Security, if you're paying tax on Social Security or not paying tax on Social Security. Social Security doesn't matter here. If you're 65 and older and you're within the income limits that I see that you have here on the thing phased out between 150 to 250 for married filing jointly. If you're under 150, you get the full amount. And if you're a couple, both under 65, you get 12,000, you get double the amount. And that applies for this year, 2025. So that is just an extra deduction on top of everything else. And that will lower the tax bill for a lot of seniors out there. So they're billing it as kind of eliminating the tax on Social Security, but really what it's doing is just an extra deduction against a taxable income so that you pay less in taxes as a senior. Number two and number three, so the line in the bill, now act, is no tax on tips, no tax on overtime. More accurately stating, it should say no income tax on some tips, no income tax on some overtime, if we were being accurate. Because what this does, it just adds an additional deduction for tips, qualifying tips and overtime. So you get that off of your income, but it doesn't do anything to those FICA taxes, the Social Security, those taxes, those still have to be paid. And there are different phase outs. So the maximum deduction that you can take is $25,000 as for the tips and overtime. And that's phased out when you start to get over certain income thresholds. And both of those features as well, the tips and overtime, apply this year, 2025. And so really, if you're looking at your tips, you're looking at overtime, you want to make sure that you can qualify for this benefit if you're going to be close to the phase out ranges, or you were thinking about maybe married filing separately. You can see the maximum deduction goes down to zero for that. So, if you're doing that from a student loan perspective, because that would be a potential reason to married filing separately, but it's going to catastrophically reduce the deduction here on your tips and overtime, you may want to rethink that. Joe, David, any other things on these completely new items?
Justin, the thing I wanted to add was on for tips and for overtime. The key word there is deduction. It's not just a removal of your income. You still have to add it to other income to come up with adjusted gross income. But then from adjusted gross income, you can deduct up to the $25,000. So that's kind of a key term, and then like the key way of doing it, because there can be other things that rely on adjusted gross income. For example, the other itemized deductions that you have, and a number of other things, other taxes and other things that you have to pay. So it's just one of those things just to note that that it is a deduction. So.
Yeah, and it's interesting too when you talk about the placement on the tax return. You have what us tax nerds would call the above the line deduction, meaning that it reduces your adjusted gross income. Then typically you had the only below the line deduction was either itemized or standard deduction. But now these are additional deductions after the itemized or standards that you don't need to itemize to take these deductions, but they're not above the line where they reduce the AGI. So this is like a new area on the tax return. Our friend Jeff Levine in the industry, which we get a lot of great knowledge from, he was calling these the below the line deductions. So until we have a better word, I like that usage of it. But that is an important note to take into account. It does not decrease your adjusted gross income.
And Justin, I would highlight here, much like I just said about the $500,000 with the SALT deduction, if you're a senior over age 65 and you're in that married filing jointly and you're in that range of $150,000 to $250,000, pay attention to these phase outs. this, whether you take money from your IRA account or your individual account makes a difference because you may lose this deduction because you took it from the wrong account. Whether you start Social Security at 65 or 70 makes a difference whether you're going to qualify for this deduction. Pay attention to these things because there's a lot of planning that is involved here. The other thing I want to highlight, and I know you mentioned it earlier, but if you see the very bottom line on each of these applies for year 2025 to 2028, there is an ending point to this, which is equivalent to the ending term of the current president. And the Congress at that time is going to have to figure out whether they're going to continue this or remove it. So this is one of the permanent, not permanent parts.
Yeah, like you said, David and Justin, it's important that that planning is done, against chunking it or just other stuff. Because one year you might qualify for this deduction and you may take, you need more money for one year, and next year maybe you don't take that money and then you qualify for it too. So the planning is very important here.
Yeah, absolutely. All right, so let's get into more new tax provisions that could be fun for people to know. The first one, car loan interest, a new deduction for new, not used or leased, U.S. assembled, we'll have to figure out what that means, cars only. Starting in this year, 2025 through 2028, a maximum deduction of up to $10,000 of the interest paid towards a qualifying car loan of a new U.S. assembled car. That is an interesting provision starting this year, again, phasing out in 2028. Another deduction, the charitable deduction for non-itemizers. So a charitable deduction is part of the itemized deductions, but what happens if you can't itemize, meaning you don't have enough deductions to be higher than the standard? Well, you don't have to take itemized deductions starting next year, 2026, so not for 2025, starting 2026, charitable deductions, you can take a maximum 2,000 married filing jointly, 1,000 for other filing statuses without the need to itemize. So this actually gives you some potential benefit for gifting charitably, even if you're not gifting enough or taking enough deductions to have an itemized deduction. And then the final, with those itemized deductions, there's a cap for higher income earners. So for those people in the 37% bracket is where this is going to affect, the maximum value of itemized deductions is capped at 35%, meaning that typically a deduction is dollar for dollar. I have a dollar of income, I have a dollar of a deduction, it's fully canceled out. In those higher brackets, a dollar of income doesn't fully get offset by a dollar of the deduction. There's a small little delta there of roughly 2%, the difference between 35, 37 that you're still going to owe taxes on. And on top of that, there's an effective, again, this is 2026 and beyond, there's a 0.5% adjusted gross income floor for your charitable contributions, meaning that for the first bit of charitable contributions you do for the itemized deductions, you don't get credit for. Once you exceed that 0.5% of adjusted gross income, that's when the charitable deductions start to count towards your itemized deduction calculation. And then what I just alluded to before, these are below the line deductions. So none of these that we just talked about reduce your adjusted gross income, the senior deduction tips, overtime, car loan interest, the charitable deduction for those that don't itemize. This all falls below the line. So your AGI is not affected by any of these provisions. And by the way, for our seniors out there, AGI is what they use to calculate IRMA. So meaning you can't use the senior deduction to help you, and IRMA is the income-related monthly adjustment amount. That's your additional payment towards Medicare if you're above a certain income threshold. None of these affect this. So this could lower your overall tax bill, but it's not going to affect your payments to Medicare because none of these affect your adjusted gross income. Joe, any comments about this slide?
So Justin, for the car interest, from what I understand, new U.S. assembled cars only. So you can have a car that's assembled someplace else in the world, but if the final assembly is in the United States, or whatever the last part is added onto the car, that is considered U.S. assembled. I don't know. That's open to interpretation. This is what I understand. So
Yep.
just so it's not like you have to move your whole operation to the United States for every car maker. It's you can have it assembled someplace else, and it comes here too. Um, the other thing I wanted to mention, just on for itemized deductions, which we haven't talked about, but I know we're going to another area, but medical expenses, they also remain the same. They're like 7.5% of adjusted gross income. You have to exceed that number in order to deduct that part for itemized deduction. That didn't change. Just so it's just one of those FYI things. So
Yep. Definitely good to mention that. Thanks, Joe.
And Justin, as a planning tip, if you are in the 37% tax bracket and you're itemizing, and you can see on the top of the slide on the right-hand column, it's maxed out at 35% starting in 2026. Itemized deductions are worth more in 2025 than they are in 2026 if you're in a 37% bracket. Accelerate those deductions to this year rather than holding them for next year.
Very, very good planning tip. And it's, circling back now to the car loan interest real quick to comment on that. We had a lot of people earlier this year with the threats of tariffs and things like rush out to buy vehicles before price increases. And now this new law passes and, maybe it's US assembled and they can benefit from this. Maybe it's not. But that's why it's, difficult to try to read the tea leaves and plan on these things. So this is one of those provisions. We'll definitely need some more qualification on to know what actually qualifies as U.S. Assembled, as you were talking about, Joe. All right, something else completely new is the Trump accounts. Again, that's their name, not a political statement. This is built on the traditional IRA chassis. So there was no real provisions in this new law to affect any IRAs, retirement accounts, Roth IRAs that was left out. But the one potential change here, or the one change, was this Trump account built on that IRA chassis. Now, the cool thing about the program and why you would want to take advantage of and know about this is for any child born this year, 2025, through 2028, the Treasury will fund the account with $1,000 for free, no catches, no clawbacks. As long as the money stays within the account, they have that $1,000. You can, in addition to that, make up to $5,000 per year of a non-deductible contribution for beneficiaries under 18. Employers can also contribute to this as well. There are some investment limitations. So you have to use a U.S. equity index fund. You can't use leverage, and it has to have a lower annual fee, which is going to be fine overall. That's probably, what you would want to do anyway for somebody young looking for growth. But then once they turn age 18, that changes. They can invest, they can day trade, they can do whatever they want with the account. Not recommending that, but that's within the rules. Now, what's interesting, and this is something else that's going to need some interpretation on and some comments from the IRS, is it's built on a traditional IRA chassis, meaning essentially at age 18, it almost gets transition into a traditional IRA. Now, they've already come out and said that the pro rata rule, meaning that if you have other traditional IRAs and you take money out of that, this is not going to clash that. So that might mean nothing to you if you don't know how IRAs are taxed. It probably means nothing to you, but that's a good thing that the rule's not going to be combined. But what could be a potentially interesting thing that I've heard some comments made by some very high-profile people is that since it's built on the traditional IRA chassis, there may be an opportunity to convert the Trump accounts from the traditional IRA chassis to the Roth IRA after age 18. That is still yet to be seen for sure, but that is something that we would need to make a comment or need to have some feedback on. But if that's not the case, these accounts, I would say, are pretty big nothing burger besides the $1,000 contribution. Otherwise, if you're only going to be investing in a U.S. mutual fund that tracks the U.S. equity and you hold it, you're not going to be paying that much tax on it anyway from the dividends. So that really is the benefit of the tax deferral. And then if you're going to have a majority of these withdrawals, the gains be taxed at ordinary income, that's typically going to be higher than the long-term capital gains rates that you would get from just holding the mutual fund outside of the accounts. So it's still, you're going to have to do some analysis to see is funding these accounts worth it or not? But the $1,000, I'll take a free $1,000 if I happen to have another child this year through 2028. Joe, David, any comments on that?
I agree with you, Justin. You want the, you don't turn down free money. So to get the $1,000, it's good. Other than that, you know, it, it's certainly better to have tax-free money in a Roth or a 529, than have to deal with this, 18, 25, whatever the age is, and then because most of the gains are probably you know, capital gains, or just increase in value. So to be taxed on that, that's yeah, it's probably not as beneficial as the other thing, the Roth for the 529. But the $1,000 is nice. So.
My only comment here is for those who are going to be playing income tax Trivial Pursuit at some point in their lives. The Trump accounts, the original idea for the Trump account came from Senator Ted Cruz. But the way politics works, they're not called Cruz accounts, they're called Trump accounts. But somewhere down the road, someone's going to ask you, whose idea was it? Answer is Ted Cruz.
They have to change that name to Cruz/Trump.
Yes. All right. So what else kind of to keep your eyes on? Estate tax education planning. So with the estate tax, that exemption was set to sunset. So it was going to go from 13.99 million to something much lower, roughly cut in half. However, for 2026, that was increased to $15 million now per person. So very, very few people have to worry about the estate tax exemption, and it was made permanent. Again, just meaning until Congress changes it. And it's going to be inflation adjusted moving forward. And portability remains, meaning that it's for, if you're married, it's 15 million for you, 15 million for your spouse. If the spouse passes away and doesn't use the full 15 million, that can get transferred over to you, and you can utilize that as well. So there was some potential concerns for some higher net worth individuals that the estate tax would fall and more people would be subject to it. That's been eliminated and extended, so 15 million per person. 529 accounts. So for those that don't know, those are specifically for educational expenses. What qualifies as a qualified expense now has been expanded. So there was a maximum annual limit increased to 20,000. It was originally 10,000. They basically doubled it for private religious elementary, secondary schools. And then they also can use it now for curriculum materials, books, different online materials, tutoring as well, with some limitations there. So the amount that you can use 529s tax-free without having to pay income taxes and penalty on the growth expanded via this bill. Any comments on that, Joe or David? All right, we're coming
for
here.
me.
No, I'm good.
Awesome. Yeah, we're coming here to the.
You explained it well.
Thank you. Coming here to the home stretch. When we talk healthcare student loans, there was a lot of different changes from Medicaid perspective, a lot of controversy there, and we're not going to dive too much into that, but just know that there was pretty drastic changes from a Medicaid perspective. There's going to be new work requirements for adults to continue to have those benefits. And so there are going to be some cuts in the savings to that over the next several years. HSA eligibility, bronze and catastrophic plans with high deductibles now can be treated as HSA eligible plans. That is effective not this year, effective next year, 2026. And David has an additional caveat to that as well that I'm sure he'll add. But before he gets into that, the final piece of the student loans, there were some catastrophic changes being thrown around in previous versions of the bill from a student loan perspective. But a lot of those were pulled back last minute thanks to the Senate parliamentary and some of the comments there. So all in all, it's definitely worse for student loan borrowers, but not as bad as it could have been. And so there's still public service loan forgiveness. That was not effective for if you're on pay as you earn, you can get on that plan up until mid 2026, July of 2026, and actually stay on that plan through July of 2028. And then there will be a new repayment assistance program, the RAP plan, that will be effective sometime in 2026. That will replace all the other plans, pay as you earn, income contingent repayment, that are, and the SAVE plan, obviously, that are going away. So if you have student loans, if you are repaying on student loans, this is definitely something you want to pay attention to. The SAVE forbearance ended this month. You still can have zero payment, but interest is now accruing on your loans. So you want to definitely address your student loan issues through before the end of the year. Also, final note on student loans, it doesn't affect anybody going to graduate school this year, or even if you get an early enrollment next year, but it does affect future graduate school programs. They are limiting the borrowing capabilities for student loans for those graduate programs. Before, you could borrow as much as you want up to the cost of attendance, cost of tuition, didn't matter. They would give you the loan for it. Now there are going to be set limits for it. So there's going to be some ramifications from this for the programs that are going to have to figure out how they're going to get their students funded. For some of the higher earning professions, it's not going to be as big of a deal. But for some of professions, like for example, pharmacists, whose average salary is around $120,000 a year, it's going to be much harder for them to justify, $300,000+ of loan expenses, because they're not going to be able to get that through the federal system. They would go private, and somebody, looking at that as an underwriter would say, this is the income, this is the borrowing. That just doesn't make sense. I might not get paid back on this. I'm not going to make it. So that's going to cause a lot of different ramifications there from the student loan perspective. But all in all, not as bad of news as it could have been. Joe, David, any comments on HSA, Medicaid, student loans?
Yeah, the one thing I'll throw out, Justin, before we call it a wrap on this, is one of the things that we don't have on our slides is what's being eliminated. And if you're thinking about buying an electronic vehicle, the credit that used to be in place till I think it was 2032, now expires in less than 60 days. So if you're buying an electric vehicle and you want that clean vehicle credit, you got till September 30th to take possession of that car. Residential clean energy credit, energy efficient home improvement credits end at the end of December of this year. And that means, by the way, that the work has to be completed, not a contract signed. You have to have the work completed by that time. So that is something that's when you don't see it on the slide, doesn't mean it doesn't. It's not important. It's going away.
Yes, and actually on that the car solar, the credit there. If you go back into our archives of a webinar, we did a webinar at the end of last year talking about potential things to prepare for this year. And we said that if you're in the market for an electric car, to probably do so sooner rather than later, because this was kind of in the tea leaves as a potential to get eliminated. Now, if there's a rush to buy these electric cars, obviously supply demand, if supply is what they have, demand is increasing, price could go up to offset the credit anyway. So if you listened to our webinar in the past, took that advice and won an electric car, got it, congratulations. If not, you do technically still have until September 30th to get that electric car credit, but you may be paying more for the car anyway if everybody's going out to try to get it before the credit expires. Yeah. Before we transition, there's one final thing, because going back to 2017, 2018, what President Trump ran on in his first term was simplifying the tax code, being able to do it on a postcard. And that was a real push for him to, be able to do that and simplify. And what this bill did, and what the Tax Cuts and Jobs Act did into this bill, I believe made it way more complicated, adding in different phase outs, different deductions, different things that are permanent, different things that will sunset. And there is a lot of mess, a lot of landmines in this bill, where you can think you're in the 12% bracket, but because of different phase outs of deductions, phase in of Social Security taxation, you can be in a much higher bracket per dollar of income that you actually earn. So I wanted to see this visually. So David, I'm going to actually ask you if you could share your screen to kind of go through what that could potentially look like.
All right, so this is an example of a software package that we use here, Personal Wealth Strategies, that is used for tax planning purposes. And I put in an example, and I'm not going to get into the details of, but we're looking at a middle class couple over age 65. And what this is showing us is, if we look at $0, that's what they're currently earning. And we say, well, what if they make an extra $1,000, $2,000? How much extra do they pay in taxes? And what you can see popping up on the screen here is all the different costs that are incurred from a tax standpoint by having extra dollars being earned. So the blue represents income taxes, right? So you can see this couple's in the 12% bracket, and they could earn another, about $46,000 before they'd go from the 12% bracket to the 22% bracket, represented by the blue and I can't, there we go, right where my cursor kind of is. But you see what happens if you earn $1,000 more. What happens is not only do you pay the 12% income tax, but you have to pay 15% on your capital gains that you weren't paying before. And you have to give back 2% of the medical expenses that you were taking off on your itemized deductions. And you have to give back 0.1% of the deductions you had on charitable contributions. And if you're over age 65, you have to give back 3.2% of the enhanced senior credit that you were receiving. And you have to put it all together here. That extra $1,000 when you're in the 12% bracket is actually going to cost you 32.4%, that top number, 32.4% in extra taxes. And you can see that those numbers kind of hold all the way down out to about $45,000 of income, where some of these clawbacks go away. And then here at about $62,000 more of income, there's yet another tax, the net investment income tax, which is a 3.8% tax on your investment gains. Now, let me take it out a little bit further. Let's say this couple actually makes $500,000 more. What happens to the scenario then? Well, what you'll see is more bumps on the road here. So here we see that recapture of the SALT deduction at 9.6% of additional cost. And then ultimately more capital gains taxes at 5%. So here's a person, if at the high enough level, paying 42% in taxes, when if you looked at the first slide that we showed, the highest tax rate's 37. How is that possible? And I could have thrown on here different other scenarios, like in New Jersey, where we have a pension exclusion, where if you hit a certain level in New Jersey state income, you fall off a cliff, and all of a sudden, what was once not taxable becomes taxable. And you can have scenarios where earning an extra $1,000 could actually cost you almost $1,000 between state and local taxes. So when I've made the comments before about planning, this is what you need to do. You need to look at this and say, what are all the different expenses? Oh, and I forgot to mention, these dotted lines represent the income related monthly maintenance amount adjustments here for your Social Security payments, for your Medicare payment. Let me get that right, on your Medicare Part B and D payments. So I mean, the government's got their hand out. There's an old expression that paying income taxes is voluntary. You don't have to make money, but certainly you don't have to walk into a buzzsaw by not paying attention to these things. So this is the difference between working with TurboTax, or back in the old days, I had a pencil and a calculator, filled out my tax return, and working with a professional who can highlight these types of concerns and making sure that you stay in the realm that's going to be most comfortable to you.
Yep, absolutely. And so the question as we wind down that you should have is, number one, how does this new bill actually affect me? And we can answer that question. I was with a client earlier this week where we were looking at, the different scenarios. And, all in all, if this bill didn't pass for 2025, their total tax bill, as we projected it out, would be about $200 more than it was last year. Nothing to write home about. With the new bill passing, there were some additional deductions they were able to capture, and now their tax bill is going to be about $2,000 less than it was last year, 2024 compared to 2025. But what's interesting, if you look in 2026, because that's where the sunset would have actually happened if this bill didn't pass, you look at 2026 for them, and they would have paid $25,000 more just in federal taxes in 2026 if the Tax Cuts and Jobs Act sunsetted without any changes. Now with the OBBBA passing, they are going to be roughly the same as what they are in 2025, assuming their income stays flat. So like those are the things like question one, like how does it affect me? And then question two that you should be asking yourself is what can I do about it? How can I legally minimize my taxes, do the right things that the government is saying that I should do and incentivizing so that I can pay the least amount out of taxes. And that's what myself, David, and Joe can offer you. So we have our contact information here on the screen. And if you would like, so with that program, Holistiplan, we can upload your 2024 tax return, take all of the data from it. We don't need any of the private information, Social Security, anything else on it. Take that information, then we can do a pro forma projection of 2025 and 2026 to show you, number one, how this affects you, and then number two, what you can potentially do about it in your specific situation so that you can maximize your benefits, minimize your taxation. So if you want to take advantage of that, email us info@personalwealthstrategies.com and just put in the subject tax webinar, and you'll be able to take advantage of that free Holistiplan review of how this affects you, and then discussing what you can do about it. David, Joe, any additions there?
I just want to reiterate your point, Justin, and David. That was a great example of what you gave. And what it tells me is that it's important throughout the year, at any time, for any changes that you think you're going to have, to think changes that you did have, or the planning is just so important that you address this in 25. And if you're not sure, just ask. Ask, Personal Wealth Strategies, ask myself, and just raise the question. Say, what if, or what happens, or I'm thinking about this. Does that work this year? What can we do about it to minimize the tax? What can we do what can we do to help my situation? Because as you've seen, like some of these things can just snowball into you becoming, you're in the next tax bracket, or you're paying a lot more taxes than you have to pay. If we deal with this sometimes in 26, when you do your taxes, you're like, well, sometimes it's too late at that point.
Yep.
So if you address it this year, or anytime that something happens, I know sometimes you're not thinking about taxes now. I mean, it's August, you want to go to the beach, right? You don't want to deal with taxes, right? You don't want to deal with taxes in March or April either, but it's just going to save you money, or just going to help your situation. And if we can help you, that's what we're here for.
And they're watching this webinar, so clearly they've got that proactive mindset. So congratulations if you're here live. If you're watching this in the replay, you're the people that we want to talk to, because you're being proactive and not just waiting for things to happen to you, proactively seeking that advice. So there's no reason not to pursue some free tax projections via the software packages that we have for you here. David, what's your final?
My final is the takeaway should not be, I can't spend my money because I'm going to get hit with taxes. The thought is, you want to spend your money on the things that you want. You want to achieve the goals that you want to achieve. But there's nothing in the tax code that says you have to pay more in taxes than you otherwise have to. So if you have a choice of taking money from the left pocket and the right pocket, and the left pocket's going to be a higher tax burden, the right pocket's a lower tax burden, we're here to tell you, take it from the right pocket. But you still want to be able to spend it. This is not change your lifestyle. This is just pay less in tax. Legally.
Yes, there's ways to not do it legally. We don't talk about those. Yes, we help you follow the law.
No slides on that.
No slides on that.
Yeah,
No. All right. Awesome. Well, thank you everybody for attending. Hopefully we found found some value in this session. We'll let you get back to your summer, your vacations, and we hope to speak with you soon.